Clients of Credo will be well aware of the firm's investment philosophy, which has been unchanged since the time of the launch of our flagship equity product, the Best Ideas Portfolio, some 7 years ago. In a nutshell, we focus on the longer term, and we therefore aim to identify matters of strategic importance rather than focusing on day-to-day news flow, most of which we consider to be noise. In particular, I'd like to focus on the second bullet point in our investment philosophy, namely that we subscribe to a value investing approach at Credo. Now, there are of course different definitions of value, and we will, for example, never call ourselves deep value investors because we think that creates the potential to fall for some value traps. However, we do follow a form of relative value investing, and we therefore tend to shun some of the most expensive companies in the investment universe, even though we would agree that a lot of them are indeed very good businesses. The reason that we are value investors at Credo is simply the fact that value works. If one looks, for example, at the work done by Farmer and French on US equities over the last 80 years, you will see that approximately 75% of the observations are above the line, which means that in approximately 75% of markets going back to 1936, value did indeed outperform growth. There are, of course, some significant periods where the opposite is true. And if you look below the line, the red shading, you can see that we've been in one of those essentially since the time of the financial crisis. Just another way of illustrating that value works is to look at the work of research affiliates, where they've essentially broken down the specific value factors and other investment style factors and shown how much value has been added by sticking to these factors over time. Once again, you can see that the value factors on the left-hand side of this slide are the ones that work best, and the growth factors on the right-hand side of the slide do not present sustainable outperformance over the longer term. As mentioned before though, the last few years have been tough for value investors. In particular, if you look at calendar year 2017, you can see that growth has in fact outperformed value by as much as 11% in that 1 year. Fast forward to the end of February this year, and you can see that that trend has continued. In fact, the differential going back to the beginning of 2017 is now approximately 16% for growth outperforming value. And clearly, that represents a challenging environment for us at Credo when we invest in terms of a value approach. Just to put this in perspective and make it sector specific, we are showing in this slide essentially two bits of information. Which sectors have performed better than the rest, and clearly you can see tech on the left hand side there being the clear winner in 2017, but then also the numbers above the bars represent the PE ratios of the various sectors at the end of the year. And even though there are some exceptions in the middle of the table, you can see that what this illustrates is that essentially the most expensive stocks have become even more expensive, and the cheapest stocks on the right hand side have become even cheaper as measured by the price earnings ratio. You can see that the outperformance of tech relative to the second best sector for 2017, tech beat the second best sector by 20%. If we view that differential in the context of the last 20 years or so, you can see that tech has managed to do this in a number of these years, but certainly not all the years. In fact, the biggest relative outperformance that tech has enjoyed over other sectors was in the building of the tech bubble in the late 1990s and into the year 2000. Why has tech outperformed so much? Well, of course, there's a lot of excitement about some of the biggest tech companies in the world. And if you look at what's been happening in terms of tech inflows into tech funds over the recent past, you can see that this has accelerated, especially at the beginning of 2018. And that explains in large part why growth has done so much better than value. Whether or not this will continue and how long it may continue for, only time will tell. We recently saw quite a sell-off in the Facebook share, for example, following some very negative news flow in that company. And that seems to have been the catalyst for some weakness across the board. But as I say, before we can say that this is the reversal of a trend that has just begun, I think it's too early to say at this stage.
So following on from Dion's presentation on value investing, I thought it would be a good idea if we just focused on two stocks that we own presently in our portfolio and give you a better indication of how we actually screen value. The first stock is Imperial Brands. We've owned Imperial Brands since the inception of the Best Ideas portfolio. The stock has been a relatively good performer until the last 2 years. So what's actually happened? Well, the industry is actually going through a state of flux. And the reason for that is that traditional combustible sales of cigarettes are actually in a state of decline. In order to combat that, what the industry has actually done is looked at other sources of revenue to supplement it. And hence, they brought in new types of products, the likes of what are known as heat not burn products or vape products. The most successful company in this respect has been Philip Morris, that has come up with a very, very successful heat not burn and has in fact taken market share. And in the case of Imperial Tobacco, they've actually been very slow to react. They do have a vape product, but it's been mildly successful. And the question that the market's been asking is, where is the new product launch? Where is the new heat not burn product? Imperial have refuted that by saying that they're in no hurry to launch product, that they're surveying the market, and they do have certain products that are ready to launch in due course. The other factor that's put pressure on the sector has been continued regulatory pressure. And this really came to the fore last summer when the FDA in the States came up with a review suggesting that they wanted to look at the levels of nicotine that are contained in combustible cigarettes. The FDA launched a report, in fact, last week, suggesting that they want to reduce the level of nicotine in combustibles to such a degree that it becomes non-addictive. The market was scared off by this commentary, and all the stocks in the sector actually declined further. So now we sit with a company like Imperial Tobacco that screens very cheaply. On a price to earnings basis, the stock trades on 8.5 times multiple and a staggering dividend yield of over 7%. And this is covered by a free cash flow yield of over 10 times or over 10%. So as we view Imperial, we think the stock is very cheap. It is unloved, and fundamentally, although the main business, which is combustible cigarettes, is in a state of decline, that decline will be long and managed. Likewise, the FDA report and subsequent regulation around that will take years to unfold, and during that time period, Imperial will have time to combat that. In fact, as I suggested, they do have heat not burn products that are ready to launch, and we think that they could be very successful with this product. The other aspect that continues to attract us to Imperial Brands is the possibility of a takeout. It's been long touted that Japan Tobacco have looked at the company and would be inclined to actually make a bid for Imperial. This has actually come to the fore relatively recently, as Japan Tobacco have appointed a new CEO who is actually head of international and is quite acquisitive in nature. And he's been on record suggesting that he would not be afraid to make a very large international acquisition. So at the end of the day, we sit with a stock that trades on an 8.5 times multiple, a significantly high dividend yield, and although it's unloved, we think it does have a certain defensive nature. And as such, we think that the fundamentals are likely to improve, that the company will arrest some of its market share losses, and in fact will re-rate at some stage. And if that doesn't happen, there's always the possibility of a takeout by a competitor. The second stock in the portfolio is a stock called Adtalem. We bought the stock when it was known as Defray Education Group. Adtalem operates for-profit colleges in the United States, Caribbean, and Brazil. The for-profit sector grew rapidly during the early 2000s, taking advantage of easily available federally guaranteed student loans. The problem with it was that it became very badly abused. So when the Obama administration took over in 2011, one of the first things it did was put in place certain means to try and stop the abuses. So things like the 90-10 rule and the gainful employment rule were put into place immediately. And the net effect of that was that this sector was absolutely routed. A lot of the offenders were either shut down, bankrupted, or were significantly fined. And it was with this background that we actually investigated investing in Adtalem. Adtalem was slightly differentiated in that we believed that over 90% of their business was actually from legitimate concerns. They had a medical sector and a nursing sector and colleges that were actually very successful and traded well. Likewise, they had international and professional education, which consisted of about 20% of the profits, mainly in Brazil. And then the last 5% of revenue, but actually the worst part of the business, was Defray Education. And this was the business that was actually one of the offenders in the whole crackdown in student loans. Our view was quite simple. The company had $350 million on its balance sheet, traded on a PE multiple of 12 times, and we were of the belief that the company had the ability either to pay significant fines if it needed to, or to shut down or to trade out of the underperforming bad side of the business. And subsequently, over the next 2 years, this is pretty much what happened. The company actually had an ability to not trade out of the underperforming business, but to clean up the businesses so they met all the regulatory requirements. So as this happened, the stock actually re-rated. That's not to say that we didn't go through a time period where the stock did actually decline even more. There was one point where the stock traded on a 7 times multiple. Having said that, in May 2017, the company actually paid all of its fines to the regulators, paying out $100 million to the federal government in fines and cleaning up its act and getting different certification, a new certification to show that they had actually complied. And since then, clearly the stock has re-rated. The stock trades on a 16 times multiple, and yet, although it's re-rated significantly, it still trades at a discount to the S&P. Why we like the stock is really threefold. One is we think it's counter-cyclical and doesn't depend on movements in the market itself. Two, we now have a Trump government that's been very kind on a regulatory basis to the sector. And three, the Trump tax has actually been very beneficial for private education and the like, because they've now become more competitive against the state loan sector. So as such, we sit with a business which we believe fundamentally has turned a corner, is in a good sector, trades well, and trades on a significant discount to the S&P and to its historic PE, and hence a company that we are comfortable to own over the longer term.